Good morning, everybody. For those of you who don't know me, my name is Spencer Waller. I'm a member of the faculty here at the law school, and I'm the director of our Institute for Consumer Antitrust Studies. We're one of the co-sponsors of the event. We're just thrilled to be the host for the law school of this great day with all the people you've heard about and all the people yet to come. My job's easy. I get to introduce this distinguished panel, which most of you already know. And then throw some questions that I can guide the panel in a conversation really about the rise of the subprime loan crisis and the housing collapse, and really set the stage for the settlement that we're talking about today. So I'll just do this in the order that we've seated ourselves. Next to me is Patrick Madigan. He's an assistant attorney general from Iowa, and he's a graduate of the University of Iowa, both undergrad and law school, clerked on the 8th Circuit, practiced law in the private sector for a number of years, and has been with the Iowa AG's office for almost 10 years now, and took a lead role in the events that we're going to be discussing. To Patrick's right is Tom Perrelli, who has had a most distinguished career in both private practice at Jenner & Block and in different stints with the Justice Department. Most recently and most relevant to the events we're going to be talking about today, he served as Associate Attorney General of the United States from approximately 2009 to 2012. He's back at Jenner & Block and is going to be giving us a lot of really amazing insights as one of the key federal players in this. You've already met Lisa Madigan, our distinguished alum and Attorney General of the state of Illinois since, I believe, 2002? Three. Okay. Elected in 2002. And then to her right is Damon Smith, who is the senior counsel to the general counsel at HUD, and prior to joining HUD in his role in the events that we're discussing today, he has taught property, local government law, and various advanced courses as a law professor at both Rutgers and American University. And prior to academia, had worked at Arnold & Porter in Washington, D.C. So we have a variety of state and federal enforcers, and my role is to guide the conversation and make this as if you're watching one of the more hopefully interesting Sunday morning talk shows, is my analogy. So Lisa, if I could just start with you and get a sense from what were the early signs and that there was something wrong, and that how your office got involved as the beginning of the subprime aspect of this crisis began to unfold.
So the history goes back a good number of years. I mean, long before you saw newspaper headlines about a crisis taking place with mortgages and foreclosures, what we were seeing in attorneys general's offices across the country was that we always have consumers coming to us, because one of the things that I think almost all of us do is we take in consumer fraud complaints. And so I, as you mentioned, have been in the AG's office for slightly over 10 years now, but from day one, we were starting to see an increasing number of homeowners calling our office with complaints about, you know, I got into this mortgage and it's got these terms that I don't understand, and the interest rate is going up and it's unaffordable. And quite frankly, when you look at the work that the AGs have done, it started 15 years ago approximately. So in 1998, First Alliance Mortgage Company, which was a non-depository lender, state chartered out of California, they started really selling a product which we now refer to as a 228. So mortgage that would have an adjustable rate, it would reset after 2 years. And when people would, we started seeing these, we'd really never seen terms of that nature before. Traditionally, everybody was getting a 30-year fixed mortgage. And so ultimately, Illinois and Minnesota and Massachusetts ended up filing a lawsuit. The FTC and other states ultimately got involved. And that was really the beginning of a wave of investigations and litigation and settlements around subprime lenders. And so after FAMCO, household finance was really the next one. And the same sorts of things. We were starting to see the terms that we had never seen before. So prepayment penalties, balloon payments, in addition to the adjustable rates. We were also seeing that people were coming to us and saying, I was told it was going to be a fixed rate, but then when I signed the documentation, and sometimes they didn't even notice it at the closing, it'd be the 2 or 3 years later that suddenly it would adjust and it became unaffordable. In addition, it was also a circumstance where people had never been qualified at that adjusted rate. So maybe you qualified at an initial teaser rate, you know, the 2%, the 3%, but you couldn't then afford it once it reset. And so after Household, which was another significant settlement that was a multi-state, we then went on to AmeriQuest, which at the time was the largest subprime lender in the country, again, based out of California. And again, it just escalated, and it escalated so much that we were seeing really an evisceration of underwriting standards, these toxic terms being loaded into mortgages, borrowers who had no understanding of what they were getting into, and when things went wrong, they were literally picking up the phone and or coming to our office with just stacks of documents, all of their mortgage paperwork. And we were in a position to investigate and unfold, well, what had happened here. So we were very much, I would say, on the front lines of the subprime lending crisis. And I remember when we started talking about this, almost every day, say in 2006, Debbie Hagan and Tom James were in a meeting with me, and they looked at me and they said, there is going to be a tidal wave of foreclosures in this country. And you have no idea because of what they were seeing, and they knew that this was taking place across the market. It got to a point where 30% of mortgages out of some of these lenders were the limited documentation mortgages. So the no doc, the low doc, the liar's loans that people refer to. And we knew that that simply wasn't going to be sustainable. And so in the aftermath of AmeriQuest, Illinois and California subpoenaed Countrywide. That turned out to be a wise thing to do. And we also had an opportunity to speak with some of their brokers who let us in on the practices that were taking place. And so late in 2008, we had a settlement there. But those are all situations where we were looking at fraud on the front end, fraud in the origination of these mortgages. What ultimately we're going to be talking about today is what happens once those mortgages went bad, the fraud that happened on the back end of these mortgages in terms of servicing. But really the way that the AGs got involved is because we really are the consumer law enforcement for everybody in their states. And people, wise people either know to come to us, and a lot of people eventually get to us, but the numbers were constantly increasing over the last 10, 15 years to the point that we saw this, I think, long before many other people either saw it or were willing to acknowledge what was going on. We only wish that we'd had a greater help and acknowledgement of it before it became the crisis that it did.
I think the timing is important because I think from the public standpoint, it was really almost late 2007 that this became sort of front and center news in the general public. And also, I read October 2007 was when the Dow hit the all-time high that we've since never even gotten back to.
Right, and that would have been, 10 years prior to that, we were starting to see this and try to take action, where we could, using our consumer protection laws against these predatory practices. And if we would have had more support at the time from the folks at the federal level, the OCC, the Federal Reserve, they certainly could have come in and done something to stop this and to ensure that the underwriting standards, were being followed, but they didn't.
Well, we're going to get to the early federal role in this as well, but I also wanted to turn to Patrick Madigan and ask you also on the early end, if you could briefly describe the work of the creation and the work of the state foreclosure prevention group that I know you were involved in.
Sure. So first of all, we should make it clear that General Madigan and I are not related, at least as far as we know. So as General Madigan was explaining, the state attorneys general really had a front row seat as to what was going on in the subprime market. We saw the fraud. We tried to warn people. We had very large settlements, and there were some unfortunately missed opportunities, I think, for the market and for others, which could have lessened the impact. But because of what we saw, because of the origination fraud, because of the inflated appraisals, we knew that there was a day of reckoning coming. And I had similar conversations with Attorney General Miller that, the staff was having in Illinois that, look, we've got a very serious situation coming in this country, which is as soon as you stop, what happened before is every time somebody got into trouble, they would just originate a new loan. And so it gave the impression that these loans performed, but these loans did not perform. And once that stopped, you're going to have a major problem. And so in the spring of 2007, I started to see a new type of complaint, where we had been focusing all of our time on origination. All of a sudden, I started to see people write into our office, and they started to ask for help. I'm in trouble, I can't afford my mortgage, is there something that you can do to help? And so I started just calling servicers. I just cold called them and told them who I was and started talking about this problem. And I would ask them, well, does it make sense to maybe, accommodate them somehow or restructure this because of taking a step back. Many of these loans had origination fraud, and many of them had inflated appraisals. And so the loss that was going to be taken on the foreclosure was going to be even greater than normal, because obviously the loan was very outsized compared to the value of the home. And so I said, look, if you do a foreclosure here, this isn't going to work out so well. How, should we do something? And it was as if I was from Mars. The concept of a loan modification in March of 2007 was non-existent. It was just like, what are you talking about? They acted like I was crazy. And so we continued to look into this, and we decided, hey, look, we really have to do something. And so in July 2007, right here in Chicago, which I think it's another, full circle that we're here in Chicago again, we invited all of the attorneys general to come and to have a conference and to warn about the impending foreclosure crisis. And out of that, we formed a group that was named the State Foreclosure Prevention Working Group, a name that doesn't exactly roll off the tongue, but that was the name. And this was a very, very active group. We had meetings with the top subprime servicers, and we were focused only on subprime loans at that time, but we met with the top 10 subprime servicers in September and November of that year, and we urged them, be proactive, modify loans. And they gave us, I think, lip service at those meetings. And they really, again, I think there was a missed opportunity. One of the things that our group did is with the help of the, the state bank regulators, who we formed a great partnership with, we developed what we refer to as a call report, and we started to collect data from the servicers as to their foreclosure and loss mitigation activity. To the best of my knowledge, we were the very first government agencies to do that. We were doing it before the OCC did it, before the Federal Reserve did it, and we were very active in that. In fact, we got into a fight with the OCC where we wanted national banks to give us this data, and they said, no, I'm sorry, you're preempted. And they wouldn't give us any data. And so one of the reasons why I mentioned that is it's relevant to when we get to 2010 and the robo-signing issue comes forth. Because while we were very, very active on a policy level in many ways, we didn't know if we had clear violations of the law in order to, actually bring an action against the servicer. A few states did, but that wasn't clear. But when robo-signing happened, that was very clearly a violation of law and a violation of state law. And we also had, in the interim, the Dodd-Frank Act, which had changed the preemption landscape significantly. And one of the issues at the beginning was, what are the national banks going to do? Are they going to come to the table? Are they going to, deal with us, or are they going to try to claim preemption? And that's something that has been talked about very little in this whole story. There's just this assumption that state attorneys general have, unlimited authority when that may not necessarily be the case. And so just the other point that I would make is the transformation over the last 12, 15 years that General Madigan was talking about, where really now state attorneys general, I believe, are the first agency contacted by consumers when they have mortgage trouble. That, I don't believe, was the case before. I don't think that they necessarily equated mortgage with attorney general, and that's been a dramatic transformation. So, for example, in Iowa, mortgage complaints are our #1 complaint by far, and the energy and the effort that we have put into servicing issues over the last 6 years has been just tremendous.
Well, as we're sort of advancing in time and moving from the origination to the servicing, but before we get there, I want to give Damon and Tom a chance to talk about the early role of the federal government as the crisis is unfolding. And I understand that some of this, Tom, predates your return to the Justice Department, but I want to give a sense of the complexity of state enforcers, state regulators, federal enforcers, and the plethora of bank and financial regulators that are potentially involved.
Sure.
And can I also, I just need everybody to talk as closely into the mic as possible, both because of the acoustics of the room and the recording that we're doing.
Sure. So I come to the department in 2009 and can speak most clearly about sort of that period. But as a backdrop to this, I think one of the very first things, I was involved in the transition, and a delegation of state attorneys general came to talk to the transition team. And one of the things they said was, what has happened to the partnership between the states and the federal government? It's not that we always see eye to eye, and not that we work together on everything, but their view was, and this was, I think, shared by quite a wide range of folks, and we heard this from law enforcement, police officers, and others, that they'd been experiencing a very top-down approach to the way the federal government was dealing with states. Whether it was on homeland security or other matters, and they gave us a list of things that they wanted fixed. And I remember this very clearly. It was a very powerful presentation, and I was actually I was surprised that at the level of concern about that. One of the first things the Attorney General did when he came into office, Attorney General Holder did, was he actually brought in all of the leaders of the attorneys general, the district attorneys, the police officers, all of those groups, all the public safety and law enforcement groups, and a big meeting whose entire point was to say, we're all in this together, let's work together, whether it's gangs, whether it's drugs, whether it's financial fraud, et cetera. And that was a tremendously important, I think, moment to sort of reestablishing relationships that needed to be rebuilt. I went subsequently out to the NAG, the National Association of Attorneys General's conference, and I did one of my favorite kind of speeches as a public official, which is I did a report card speech, which is I took what they gave us, the list of things they wanted us to do from transition, and I just reported on what we had done, including, evolving view on preemption and other things. And, I often say to Tom, that was the I had them at hello speech. The fact that I'd gotten there, I'd actually shown up was thing enough. But that, I think, really was that change in tone, the creation of the Financial Fraud Enforcement Task Force at the department, which was intended to be the biggest sort of financial fraud collaboration ever in conjunction with the state attorneys general. The S&P case, which you saw recently, is a fruit of quite long labor by folks in this room and many others. I do want to focus on one other thing that is was of interest and is not a well-told part of the story. just like the attorneys general really are on the front line of what's happening to mortgagees all across the country, one of the things that I discovered was that the place where the federal government most commonly intersects with this, because we don't have, the Justice Department doesn't have General Consumer Protection Authority, we don't have an FTC-like statute, and the FTC has its limitations. We don't have actually the scope that state attorneys general do. But is our bankruptcy trustees, where we see all of this play out in Technicolor, is in bankruptcy. And our trustees all across the country were telling us exactly the kind of servicing issues that the state AGs were hearing. And folks may remember in 2010, the FTC and the bankruptcy trustees entered into a $108 million settlement with Countrywide over servicing issues. And it was really basic stuff. People are being, and it was not about robo-signing, it was about fees that weren't charged. If they were overcharged or wrong numbers put into people's, into the claims that the banks were making in bankruptcy. That combined with the sense that we were getting from bankruptcy judges, from actually federal court judges, because there were a couple of federal courts where the banks had gotten sick of state courts not being as fast as they wanted them to be, so they decided to bring all their foreclosures into federal court. And the judges would come to us and say, I'm sitting here every day with lawyers who have no idea the paperwork they're submitting to us. Their numbers are all wrong. They don't make any sense. Why isn't anyone doing something about this? And so we had this settlement with Countrywide, and we had started looking at the same kinds of issues with other institutions, and that's really in 2010. And then, of course, robo-signing hits, and we'll sort of get to tell that tale soon. So I'll let Damon talk a little bit about it.
So Damon, if you could address it from the point of view of HUD and the role in those years as we build up to the robo-signing.
Sure. I mean, certainly I come in 2009 as well as a member of the Obama administration, and so certainly we could spend days having forums that talk about TARP and making home affordable and the many federal responses to the foreclosure crisis and the housing crisis. Certainly from our perspective, and I think Secretary Donovan will touch on it in his remarks, the work that was being done by Treasury and Secretary Donovan in the White House on what is now known as HAMP and HARP, despite the difficulties of getting it off the ground, really did sort of set the stage for making modification a word that would be recognized when Patrick Madigan and others would have those phone calls with banks as well, and certainly set the stage for what we're seeing now in terms of both continued mods on those programs and in proprietary modifications that banks engage in themselves. But leaving that aside and sort of focusing instead on the servicing aspect of it, HUD came to the table from a slightly different angle. As many of you or most of you already know, HUD, as a part of HUD, is the Federal Housing Administration, and FHA doesn't own any loans or hold any loans, but they insure loans. And they insure loans that are originated by these banks in accordance with FHA requirements and that are supposed to be serviced in accordance with FHA requirements. And one of the, certainly as we were coming in, the new administration in 2009, we're starting to see losses pile up on books that were poorly originated in the, sort of as the housing bubble erupted. And the question that was asked, both by our Inspector General, and we have David Montoya here, our Inspector General, and certainly by our Quality Assurance Division, why are all these claims coming to us when we have in place a very robust loss mitigation loan modification requirement that the banks as servicers are supposed to go through before they foreclose on a FHA loan and have a full payment, a full claim that has to be paid by FHA. And so an investigation was started in the summer of 2010, so before the robo-signing really erupted, that was finding both because of the work the Inspector General's office was doing and work that FHA was doing, was finding massive non-compliance with FHA requirements. Loss mitigation type activities include short sales or partial payments of claims that allow the borrower to stay in the home, and forbearance, other deferment of principal and interest that would prevent FHA from having to pay a full claim and would allow the borrower either to stay in the home or exit the home with dignity and not have the entire cost of holding the properties borne by FHA and our mutual mortgage insurance fund. And so it was in the midst of beginning discussions and conversations with the banks about that non-compliance and the penalties that they would need to pay and the practices that would need to change to come into compliance with FHA requirements that the robo-signing controversy erupted in the fall of 2010.
Well, that's clearly one of what somebody's already referred to as the game changer. But I think it's important to talk about that right now, which is how did it erupt for those of us whose memories are failing, and how did it change the reactions of the state and the federal?
So let me start by saying one thing. Tom did a very nice job of talking about the partnership that has really just blossomed over the last 4 years with states and the Department of Justice, and really in HUD and other federal agencies. And if Tom Miller was up here, he'd say the exact same thing. And as I mentioned, he's been doing this longer than I have. We have never, I think, in the history of this country, had a relationship with the federal government that we have today. And as you obviously can tell just by looking at the composition of this panel and the resulting settlement, it was absolutely vital to making sure that this got done. And so it's just been a world of difference, because we had spent so many years prior to the Obama administration's commitment to work with us at a state level, really just fighting against federal regulators and getting no support from federal agencies, where if we had had that relationship, we'd like to believe we could have, prevented much of this chaos from happening to our economy and to families and our communities. So keep in your head that this is one of the most significant accomplishments of this settlement, is the relationships that we have built and that are continuing to this day. Now, in terms of robo-signing, how did that change everything? It gave us a hook, as Patrick just said. So suddenly we start hearing out of courts around the country, we start seeing on television that there are so-called robo-signers. So people whose job is literally to sit at a desk, and they have requirements to sign who knows how many affidavits, pieces of paper every single day. So there are these, essentially, I always look at it, they're foreclosure mills, and they've got to have the documentation to file the lawsuits. And so what happens is there is a massive fraud on the courts across the country that's being committed. So people without any actual knowledge of the information in these affidavits are signing them. We went over to the Circuit Court of Cook County, and we did a sampling. And our sample showed that over 80% of the foreclosure filings here in Cook County contained documents that were signed by known robo-signers. So people whose names had appeared in these court cases and in the media as robo-signers. And what we found were, affidavits that, literally either were signed by these people. Sometimes there was just an X that had been signed on them, and there wasn't even a name. Sometimes the signature was blank. Sometimes you could tell that the document, something had been signed, and then the documents had been pulled apart and something else had been stapled onto it. We certainly found instances where, there were inaccuracies or just blanks in terms of numbers and information that should have been in the documents. And so it gave us a hook. There was fraud being committed across the country in the courts and on the courts. And so we suddenly had a real way to say, all right, banks, come on in, because there's an issue that absolutely is going to be dealt with. And as you'll hear more about, it was that hook in large part that allowed us to then address the other aspect of this that is incredibly significant, which is the servicing standards. Because the horror stories that we had all been hearing in our offices, and housing counselors and legal aid lawyers across the country had been working with people to try to resolve, were becoming legend at that point. So you try to get a modification, and God forbid you try to do it on your own, you can't really get the banks to respond to you. It's a very complex process. You send your documentation in 1 time, 2 times, 10 times. You're never talking to the same person. They don't know what's going on. You're dual track. They tell you, well, maybe we'll get you a modification, but then the next thing you know, you're in foreclosure and maybe your house is up for sale. So all of these problems, we were able to, when we brought the banks in, also say, we're not just going to end robo-signing, but we're going to end the servicing problems. And truth be told, that's what they spent, probably the vast majority of time on as part of the settlement. But robo-signing gave us the hook to pull the banks to the table and to say, this is a problem, but here are some other problems we have to deal with.
I'd also say, I mean, on the federal side, it got everybody in the same room. I can remember, within a couple of days of the robo-signing breaking, having all of the senior, and I'm talking at very senior levels, Secretary Donovan, myself, the leading people at the banking regulators, all actually in the same room together, with a recognition that we all had pieces of, we all had sort of pieces of responsibility for this. We were all, might well take investigations and remedies in lots of different directions, but it got us all in the same room. Frankly, it's the first time I ever knew that HUD was doing the investigations that it was doing, and which were eye-opening to say the least. We got to hear from the banking regulators about what the efforts that they were about to undertake. And it got us into a discussion about, it's not just robo-signing, what about all of the other things that need to be dealt with? And so it was at that moment that I think there was at least on the federal side, the sense that, if we don't actually find a way to collaborate, we're all going to sort of pull potentially in different directions. And that's going to end up in a result that doesn't really help, that may not help anyone, or it may not help as much as we could. And so that, I think, was a very important, again, on the federal side. And then our early outreach with our state partners, we sort of just, not only came to recognize, how much more information they brought to the table, and obviously the level of concern that they had, but really we saw the sort of opportunity for a real partnership here if we were able to all work together.
So at this stage, were there any real precedents for having this broad array of all the federal agencies and all the state AGs beginning to come together as the full effect of this is all unfolding?
I mean, I'll say from the federal side, people throughout this process over and over again said, we've never seen anything like this. This hasn't really been done before. So that was the constant refrain.
Yeah, we had at least one of the initial meetings. I mean, I remember we were all kind of shocked because here we were in rooms with people, because they're banking regulators who we have fought against for 10 years, at least 15 years, because they were constantly saying, we were preempted from doing anything, and so suddenly, it's like placing the face with the name of the people we really don't get along with. But we were all in this, truth be told, but we were all in this together because we all had different authority, right? And very strong authority. And we were all, preparing to use it, and it seemed to make a lot more sense to do that as a group. Now, obviously, as the day goes on, you'll hear about, it's not easy to keep a group that large together. It's not even, you can't keep 50 attorneys general together. So imagine keeping
49.
We did okay. But, literally, you had the OCC, you had the OTS, you had the Federal Reserve. I mean, you have this whole array of federal folks that, and we often find ourselves on opposite ends of the spectrum.
Well, since you can't tell the players without a scorecard, Damon, walk us through who the federal players were, and then Patrick, tell us who the state players were as we're getting to put together these meetings and eventually negotiating teams once you bring the industry to the table.
Well, Tom might be in a better position to make sure we don't miss anybody, but certainly, from our perspective, the early meetings were an impressive array of sort of alphabet soup. We had the Office of Thrift Supervision, we had the Office of the Comptroller of the Currency, we had the regulators of Fannie and Freddie, FHFA in the room, we had as well as HUD, other entities in the federal government who insure or guarantee mortgages. It was an impressive array, all led very ably, I might add, by the Department of Justice and Tom Perrelli.
I mean, if you think about it, and this is fast forwarding ahead a little bit, but our first meeting at the Justice Department was in a room larger than this, with more people than this. Okay, and this massive square table with probably 75 people at the table, and then scads of staff behind. And as Damon said, so you had DOJ, HUD, OCC, Fed, OTS, the incipient CFPB, who was there observing even though they didn't exist yet, FDIC, SEC, FIFA, Treasury, FTC. And then over time, we engaged, among others, with VA, with DOD on some of the military family issues, with AG, FTC, bankruptcy trustees, part of the Justice Department, all there, and as well as attorneys general from, from both sides of the aisle, who, have plenty of disagreements about all kinds of things. But the one thing everybody was in lockstep agreement was the people in their states were complaining about the service that they were getting and the treatment that they were getting, and that was uniform. And that, I think, was made, having all of those folks together, as well as the powerful statements about the individual situations that AGs in particular had heard about, I think would send an immensely powerful message that we were serious about this, and we were actually, that something was going to come out of this.
And then the other group that, I don't know if anyone's mentioned, but the state bank regulators, they were hand-in-hand partners with the state AGs, and obviously very important because they know what's going on in these banks in their states. And so, we've got John Ryan here, who's head of those folks, but they were great.
Well, on the state side, I think the work that we had done going back to 2007 was a tremendous benefit to us. And so while servicing, a lot of people became aware of servicing issues kind of for the first time when robo-signing became this new term that everybody started using. It was not new to us. And in fact, we had been very deep into servicing issues on a policy level for many years. And so when this broke, we had the infrastructure to move very quickly. We already had an existing group. We already had the partnership with with CSBS and the state banking regulators. And so within a matter of weeks, we had organized a 50-state, multi-state, 50 AGs in a very large number of state mortgage regulators. And so we were able to move very, very quickly. And there's also, I think, there's this kind of this group of assistant attorneys general who know each other and have worked together for years on the origination issues and then the servicing issues. And so again, that prior work allowed us to get ourselves organized very quickly.
Well, let me follow on to what Patrick said, because what he didn't say is there are a group of assistant attorneys general who spent every single day for the 16 months on a phone call that lasted at a minimum 1 hour and some days 8 hours making this happen. And so, I get to sit around, and a lot of us AGs get to sit around taking, great credit, but the reality is that Patrick Madigan and Debbie Hagan and Dave Huey, and I don't know, do we have any other folks that were on the calls? Susan, who's over here, this went on for so long, she had a child or two. It's like the movies where at the end of the credits, it's, the production babies or whatever they call them. So, so that happened. But, incredible dedication by a small core. So here's what happens with multi-states, right? There's an executive committee that's formed. There are, assistant attorneys general who really take charge of the issue. And we had a bipartisan group that did that. Were there 8 of you total? Some of those calls, there were definitely more than 8 of you on them. But, and I would come in and listen and sometimes be like, oh, I don't know how you do this every day, and walk out of the room. But they did, and they made it happen. They really deserve an enormous, enormous amount of credit and appreciation.
So you talked about how the robo-siding was the hook to bring the industry to the table. Now, who came to the table, and how did those discussions begin to unfold? Because you've got this tremendous array led by executive committees and allocations of responsibility on your side. And what did it take to get the other side to be there? Who was the other side, and how did we get from the conversation to the eventual framework that led to the settlement?
If I could jump in on there, as I mentioned earlier, there was a big unknown as to, because these were national banks, and we had spent the better part of 10 or 15 years fighting with the OCC, as General Madigan had mentioned, about what our authority was, what was going to happen. And I remember very, very clearly when we contacted, Chase, Bank of America, Wells Fargo, and they said, well, why don't we come out to Des Moines, Iowa? And sitting in Attorney General Miller's office with very, very high-level executives and lawyers from these national banks there in Des Moines, Iowa. And I thought, okay, we are in a different place now, and we were. And so on the state side, that's how it first started.
Okay, so we know where, we know who.
Well, and the who, I mean, I think the who is in some ways obvious. I mean, it was the largest mortgage servicers in the country. So Bank of America, at the time, and continues to have an enormous portion. So it was Bank of America, Chase, Wells, Citi, and GMAC Ally.
Right, which was 80% of the sort of servicing market, at least at that time. Obviously, percentages change over time.
Well, can we talk, as this conversations are beginning to unfold, as the coalition on both sides are having their internal deliberations and their conversations with each other, what's going on outside the room and outside the conference calls in terms of the pressures that you're getting, the role of consumer groups, the role of industry, the role of the legislature? You had a tremendous confluence of forces that are trying to exert pressure on the evolving conversation.
Just to sort of kick that off, one thing to note, I'm not sure if this is sort of fading in and out here. One thing to note is that while these conversations and conference calls and everything else are going on, investigations are taking place, so at every single level. And so it's not as if you hang up the conference call and you go back to doing something else. It was an intensive time when certainly, again, to hold up our Office of Inspector General and others were actively involved in collecting information, interviewing people at the banks, looking over documents and data, and putting together, along with folks at DOJ and others who are here, a real picture of what types of liabilities we were talking about, what the problems are, and at the same time trying to discover what is the framework for a settlement, which I know we'll come to later. And so a lot of very complex things going on at the same time. I think I've heard Tom and folks in his office describe it as building a plane as you're flying a plane as you're building it. So that was what was really consuming a lot of our time. But certainly we were hearing from outside organizations, be they consumer groups or homeowners who were calling and complaining to attorneys general, certainly legal organizations and others, about the real depth of the problem that we were facing and the difficulty.
And I'll give a shout out to the HUD Inspector General as well, because they investigated the robo-signing set of allegations as well as some collateral aspects of that in an incredibly fast timetable for any federal agency. They got on it, and we got on it fast and gave us a much clearer picture of sort of what was going on. A really, really impressive body of work in a short amount of time. The other thing we did, and then I'll go into sort of some of the outside exterior issues. We had the bankruptcy trustees in, I think it was 17 districts for the 5 major servicers just go through in tremendous detail. This was an enormous amount of effort. Every single bankruptcy filing to see, are people being charged the right amount of money? The bankruptcy trustees their experience had been whenever they found something wrong, all of a sudden the bank and the borrower would go off and somehow either something would happen and then everything was either fixed or changed or different. But they weren't doing that in every case because they didn't have the resources. We diverted a bunch of resources and put an enormous amount of people on this. And what we found was that the error rate in the filings in bankruptcy was, and I can't remember sort of exact numbers for you, but it wasn't a passing grade, okay? And so it's just the kind of thing where if this was what was showing up in bankruptcy, it's almost certain that's what's happening in foreclosure, and you can, So very difficult to ever get yourself into answer the question of, with a particular consumer, were they not offered a mod they should have been offered based on was paperwork lost, or were they unfairly treated? But these things were quantifiable and observable in a much easier way. On the sort of external, front, once there was discussion in the air about the possibility of some kind of resolution, you name it, sort of came in the door to visit, right? Consumer groups and housing counselors and advocates, the hedge funds who had their own views about what should happen here, and the mortgage investors. You had smaller banks, smaller institutions who I think their most significant concern was, don't create a regime that would result in everybody being treated like the biggest banks, because we're smaller and we're different. And a slew of other, everybody who's sort of interested in this space. And my sense is that all of us learned a lot from that, but for the most part, we were very focused on, how do we actually bring relief to consumers? What is the most effective way to do that? And we had an enormous range of discussions, very much informed, I think, by the consumer advocates and housing counselors we met, about how you could actually achieve that in a resolution that we thought at that time, and this is early 2011, would be of significant scope, but we didn't know how big.
Let me follow up. I want to say one thing, really, to set the record straight. There was some criticism, particularly toward the end when we did reach the settlement, about, well, there's been no investigation done. And as you've just heard, there was an enormous amount of investigation that was done leading up to the eventual settlement. Credit absolutely due to HUD and the Inspector General there. I mean, those reports were really provocative and disturbing. But also, I loved the bankruptcy trustees. I mean, they were among my favorite people to sit in a room with, particularly when we were across the table from the banks, because they're just no nonsense. And they had seen it all and been through the ringer that we often get put through when we're dealing, in an adversarial position. And they were terrific. But again, folks that aren't being mentioned are the state bank regulators, who were also involved in their own investigations at the time and had put in a significant amount of work and given us a significant amount of data. And that's on top of, I already mentioned some of what we had done in Illinois, but that was taking place across the country. So we had an enormous amount of information about the fraud that had been taking place, both in terms of robo-signing and in terms of servicing. And so this idea that there was no investigation done and we were just, trying to get a settlement done is completely absurd, because everybody invested resources because we wanted to know and had to know the depths of the problems in order to fashion a remedy that would eliminate them from going on in the future. So I just wanted to make sure you all heard that, because somebody needs to.
Patrick, I'm sorry, Tom, your comments about the bankruptcy trustees are really telling, because fortunately that's one of the areas of justice that was directly under your supervision as the Associate Attorney General, so that brought an important part to the element. But Patrick and the others, so when did you first see, or how is it that the light at the end of the tunnel emerged that there would be a potential for a framework to resolve this after months of negotiation? How did that just happen? I'm fascinated. This is like my peek inside the room, for which I was never part of.
I don't know if I know the answer to that question. We were very committed to seeing this through. We had struggled with mortgage servicing for a number of years and knew that this was our opportunity. This is where we were going to put into place the standards that were going to make a difference in regular people's lives as they are dealing with their home, their most important financial asset, and really the centerpiece of the family. And so when the light came, I don't know, because there were some dark days. But
the light went on and off.
Yeah. But I think I should defer to Tom on this one, because without the extraordinary leadership of Tom personally and Secretary Donovan, we would have never made it. And so it was a long road.
Yeah. I'll talk a little. I mean, I guess a little bit about it. And this is sort of very much my perspective, maybe not anybody else's. I don't know. A couple of things there. Obviously, early on in the discussions, you heard a lot of debate outside of our settlement discussions about principal reduction, no principal reduction, disagreements among folks, as well, including, there are folks in state and federal government who don't like principal reduction, and there are folks in state and federal government who love principal reduction. And we heard all of those views. But I think it really in late spring of 2011, the rough structure, which included the idea of what we call the menu, which is the framework of relief with caps and minimums and different levels of credit for different activities, as well as really the opportunity for, that there would be money that would go to each state that would give each state the opportunity to determine what is the most effective way to help individual borrowers in their states. But a rough framework started to come into, I guess, into our vision. We had a sense of it. And in talking to a lot of the players, because there was definitely a period where this felt like a bilateral negotiation, where I was bilaterally negotiating with, different groups of AGs, each federal agency I talked to individually and separately. The banks wouldn't all get in the room together. So, my day was I talk one-on-one to these people and trying to figure out what they, and for me, because I was sort of in the middle of this, this sense of there is a framework that's going to work. I saw that in, probably by July, call it July of 2011. I was convinced there was a place we could all meet. Whether that was actually going to happen or not, that's another kettle of fish because it's challenging. Even though we spent an enormous amount of time at the beginning working on the servicing standards, and there was never any doubt, I think, in my mind that we were going to get to the end on servicing standards. The money and relief is a more challenging thing, but even there, my instinct was there was a place that that would work, notwithstanding, that. When you sat in a room with people, if you did offer and counter offer, you weren't necessarily going to get very far.
Damon, it seems that the servicing standards, in essence, using this settlement to sort of create de facto servicing standards, is an extraordinary accomplishment because it uses a resolution of litigation and other grievances to achieve a very almost legislative-like outcome.
Well, interesting you put it that way. Certainly, some of the criticisms we heard was that it was a legislative-like outcome, which seemed odd.
I was saying, Damon, I was saying it in a good way.
Let me just say that certainly the servicing standards were an essential part of this. It became clear along the timeline that Tom mentioned that the framework for settlement was going to be some form of cash payments and penalties, including some amount of restitutions for borrowers who had been foreclosed upon. It was going to have a component that looked at the housing market and provided consumer relief to assist borrowers who were still struggling to stay in their homes. We also were going to have servicing standards, which I think Brian Hauk, who worked for Tom and was an absolute stalwart and essential part of this negotiation, described it accurately, which was it's relatively standard in litigation to have fencing of the behavior of the defendant on a going forward basis. And while the servicing standards, were somewhat voluminous in terms of the number of them, it really is impressive when you look at what the state attorneys general and the bankruptcy trustees who took the rowing oar on those servicing standards were able to put together based on an incredible amount of information that they had gathered about the problems that we're having in servicing, and that they were able to craft together these 300 servicing standards that said, you will stop engaging in these practices and here's how. And I think really testament to how impressive that effort was and the expertise that they brought to the table is the fact that the Consumer Financial Protection Bureau, when under Dodd-Frank, put out the regulations in January of this year that they were required to for servicing standards across the nation, adopted almost wholesale those standards when it comes to borrowers who are facing foreclosure or in need of loss mitigation. An absolutely superb effort on their part.
What else were some of the things that would have been deal breakers that you would not have reached the settlement if it had not included? Obviously, the money and the relief, the servicing standards, You retained the right to bring both civil and criminal causes of action. Was there anything else that were simply flat-out deal breakers that?
I mean, the release issues were big issues, and you know, one of my biggest frustrations, you talk about the people saying no investigation, you know, and I'm not as conversant as I was a year ago, but the sheer number of things not released here, when people really focus on that, the list of things not released is an incredibly long list. It's no criminal, you know, not releasing securitization related claims, you know, all of the safety and soundness stuff. The CFPB has some residual jurisdiction. There's just a slew of things not released. All the civil rights stuff. And so it did, and as you see, and there's already been litigation about what was released and what was not released, which at least to date the United States has won. You know, that is, I think there probably will be some ongoing issues, but that piece of it, I think, you know, was a, you know, something that, you know, we were negotiating sort of late, and once, but once we sort of got, and you know, on the federal side, we were negotiating this right, you know, I think the states actually, you know, were able to work their things out. It was the feds were negotiating this towards the end.
Well, let me add some color, because that seems to be my job. So my recollection is there were at least 10 months worth of us negotiating on the release. I mean, at least, right? So my recollection is, and this won't surprise anybody, so, you know, there was all this commentary about we were going to be releasing everything, when in fact, we weren't going to be releasing much at all. And we had very specifically, you know, I think from day one said, we're not releasing securitization, we're not releasing criminal claims, we're not releasing fair lending, because we had a number of fair lending lawsuits still that were ongoing at the time. And so there were all these things we weren't releasing, but it's no surprise that, yes, the banks asked us to release absolutely everything. And so out in the media, and I think certainly among a lot of the consumer advocate groups, there was this misinformation that we were somehow going to be releasing an enormous number of claims that obviously we weren't seeking compensation for in this, because we really were focused on robo-signing and the servicing standards. And so, you know, that was just an aspect of it that at least publicly proved to be aggravating, whereas, you know, obviously it was kind of, you know, hand-to-hand combat for many months over what is the release ultimately going to look like. But there was just never a day that we were releasing criminal conduct. There was never a day we were releasing securitization. I mean, those things were just never even negotiable. Did the banks ask every other week? Yeah, but that was just never going to happen.
And just, again, because we're kind of setting the record straight on this, you know, I think,
take the chance.
You know, the state release was essentially negotiated in July and August of 2011, and maybe some minor details changed, but there's this mythology that there was a dramatic change that happened in the scope of the release between then and the announcement, and that is just completely false.
Well, one important thing that we're going to talk more about the substance of, but is the decision to use a monitor, outside monitor. In some of the other areas that I follow, using monitors is very common, but I think it was an unusual and important step of this process. And maybe, Tom, can you talk about how that arose in the course of these dealings?
I mean, I think certainly from the federal perspective, I think our going-in view was we needed a monitor, we needed a strong monitor. And as you negotiate something of this scope, when you get there any number of times where we said, you know, we could do it this way, but boy, that would only work if we had a really great monitor. And so there was no question that when we got to, you know, that I think early on that became an absolute a decision we made, that, you know, we were going to have a monitor, and as the negotiations went on, I think the certainty that we wanted to get the monitor that we wanted to get increased over time, and so that was, you know, that was a non-negotiable, was going to be a non-negotiable item for us, and we were so thrilled that Joe took this on and has done such a fantastic job. I mean, you know, interesting, and one other thing that I think is interesting about this, which hasn't gotten that much discussion, but, you know, in a lot of past the work that the state AGs have done, you will do something in state court, or or you might do an agreement, a sort of bilateral agreement or an individual agreement with the state. The idea of doing a big resolution with all these parties in a federal court, in DC, unusual. I actually think that's in some ways a testament to the level of trust and sort of collaboration that was built up over time, because particularly on something where servicing standards, where I think we recognize that whatever the servicing standards are, if there are 50 different flavors of them, that's not going to go well. Whatever you think of the banks implementing 50 different things, not their best thing. And so the idea of having a single thing with the authority of a federal court was not a no-brainer, but it was, I think, again, a testament to sort of the collaboration and trust built up over time.
Let me talk a little bit about our perspective of why a monitor was important. So back in 2008, when we ultimately settled our initial litigation against Countrywide on the origination problems, that settlement was estimated to provide benefit to 400,000 homeowners, roughly $8.7 billion worth of relief. We did not have a monitor, so it was really the first time ever that we had put in a modification component to a settlement. And we found that it was just very, very difficult for us to track what was actually being done. And so here with this settlement, we were looking at something that was substantially larger, $25 billion. And the way we had structured it in terms of the banks receiving credit for what they did, they weren't always going to get dollar for dollar credit based on what they did. So sometimes it was only going to be, 90 cents on the dollar, 50 cents, 10 cents on the dollar. So you really have to have somebody who is able to, do the math and make sure it works out and that they're meeting their obligations under the settlement. And I just don't think we saw a way to do that short of having a monitor in place, which was just absolutely critical because we didn't want to be in the position that we had found ourselves in previously with very large settlements of saying, well, this sounds great, it's supposed to be great, but we're still getting complaints, and it's very difficult to have, within an AG's office at least, somebody looking over that. We wanted somebody with the banking experience and the integrity to get that done and look over it. So it was a critical piece, I think, from day one.
And just one last comment on it. I think from a state attorney's general perspective, the fact that state AGs were able to get an agreement where there was a monitor over national banks is really an extraordinary achievement and one that's not always recognized.
Well, I want to give everybody, before we sort of turn from the past to the future, any last comments from anybody about the framework that emerged and the process. We haven't gone into the details of the substance of it because it's lengthy and complicated, but
I would just add before we turn perhaps to questions and other things, what we came together and talked about yesterday, General Madigan and General Miller and Secretary Donovan with a couple of homeowners who've received principal reduction here in Chicago, was I think certainly the culmination of on the consumer relief framework of that document, as we call it, the menu, really playing out in a way that, as has been mentioned on several occasions, has actually exceeded expectations. People ask if there were any compromises. I mean, certainly there were, as mentioned earlier, there are some people who don't like principal reduction, some that do. It is a new tool in the toolkit now that servicers have to be able to help people who are delinquent and underwater stay in their homes where possible to bring their payments down to something they can afford. $10.5 billion of completed in-trial modifications as a result. People ask what compromises were made. You can see it in the document itself. The menu framework gives dollar for dollar credit for things like helping people stay in their homes. It gives 10 cents of credit for things like forgiving a deficiency judgment or a very delinquent second lien loan. We recognize that for a borrower who has a collection agency that calls them once a week, adding insult to injury on a foreclosure that they had, forgiving that deficiency is important. But we also recognize it wasn't valued the same way by the banks, and frankly, we wanted to make sure that we put our thumb on the scale for keeping as many people in their homes as possible. And so certainly you can see that reflected both in the document and the framework that was really provided by the leadership in this effort.
And I would say, you know, there were other concepts or other approaches one could have tried or in this area. You know, could do the, you know, put aside a bunch of money and have a monitor and administrator figure out and dole it out to folks. You know, I think exceptionally challenging to build the engine you would need to actually do that. You know, I think at some level the challenge that the OCC and the others faced as they were doing their independent review is some testament that how difficult that is. You know, could have had a much more prescriptive approach. You banks will modify these particular types of loans in this particular way, and I think, you know, you know, you have the question of, you know, can you get all of the parties that you need to get on board with as prescriptive approach? Plus the uncertainty that, you know, not everybody who has that particular type of mortgage or that particular product might need that particular type of relief. And so the idea that there were lots of different problems folks were trying to solve, and lots of different perspectives on how to solve them, I think led us in part to the menu, and then a lot of discussion and negotiation about how to do the crediting of the menu and the caps and the minimums and the caps on the menu in a way to achieve the greatest result. And look, when we, you know, it's right that, you know, we, based on the caps and the minimums, you know, we had a sense of what we thought. You know, we knew it was more than $25 billion, and we had estimates about what we thought it would be. It has exceeded those expectations.
There's one other aspect about this that I think made this unique, which is time. Litigation is not the most efficient process, certainly not the shortest process, and we've done lots of deals, and what made this interesting was every day we were losing people. Every day, people were losing their homes to foreclosure who could have been helped by either the servicing standards or by the menu relief. And so while we were criticized for moving too fast, we were criticized for moving too slow. Sometimes the same people criticized us both ways. There really was a time element here that, at least in my experience, has never been present in another case that I've worked on. And that was, you know, I wish we could have done it sooner. I wish we could have done it a couple of years earlier than we did it, where it could have had an even bigger impact. But we had an obligation to try to get it done in a reasonable amount of time.
Looking forward, does the process and the coalitions and the relationships that were developed, does it provide any roadmaps for application in other areas, whether it's antitrust, whether it's frequent state-federal cooperation, any future versions of tobacco-type litigation, the present S&P litigation? How can this be a roadmap?
Well, I do think that the present S&P litigation is testament to this coalition that has been built. So the Financial Fraud Task Force out of the Justice Department brought many of us in the room in the first place, you know, 4 years ago, 3 years ago, for the first time, as we talked about early on. And so, as you saw, there are a couple of states, Connecticut, Illinois, is it Mississippi, who initially sued S&P a year or two out. And now we've got a situation where just the other week, we all went out to DC to announce that there are now 16 total states that have sued S&P, as well as the federal government. And again, I think that a main reason for that happening is that we have spent this time together, we trust each other, we know that we are more powerful when we work together. And you know, it's heartening because in terms of the litigation that's been going on at the state level, you know, it's litigation, as Patrick described, and it could go on for a long time. But once you bring in the power of the federal government, they're really a game changer, needless to say. And so I'm looking forward to continuing to make sure that we're holding all of these market participants accountable for what happened to our economy. You know, as I've talked about, we've been seeing this building for 15 years. We like to think that we could have prevented this from happening if we actually had this type of a partnership and this amount of appreciation from the federal level that we have now. But now what we're left with is cleaning up the mess as best we can. It's never going to be good enough to clean up the entire situation, but I have to say, and Damon mentioned it, yesterday when we sat down with some of the housing counselors, it was really heartening because what they testified to was the fact that just a few years ago, they were meeting with homeowners who could not stay in their homes, who were facing foreclosure, and they had no tools and they had no hope. I mean, it was basically moral authority that they were working on with these servicers. And they literally looked at us and said, thank you. You have given us tools and you have given us hope, and we are actually seeing unimaginable types of relief for homeowners, and we really are saving people's homes. And by doing that, we all know we're saving not just, you know, the home and that family in that home, but we're saving communities, rebuilding our housing market. So it's extraordinary work that I know none of us wish we ever had to do. We wish we could have prevented it, but thank God we've got this partnership that is going to clean things up, and I think is going to continue working in the future to make sure this doesn't happen again. But God forbid something does, we've got the relationships to try to stop it as soon as possible.
Well, this is my chance as moderator to, before we turn it over to questions, to ask the panelists for any scoops and predictions, the same way they would on Chris Matthews or other kind of talk show. Patrick Madigan, scoops and predictions.
You know, it's been working on servicing for 6 years now, which is really, really hard to believe. And one thing I just want to make clear is, you know, look, we're not naive about it, okay? I mean, servicing was broken in this country, in my opinion. And the analogy that I like to use is this isn't just like turning an aircraft carrier around, this is turning a fleet of aircraft carriers around. And so there's a lot of work left to be done, and we know that through the very robust monitoring process that we've put in place, that we still have work to do. We know it's not perfect. We know we didn't fix it overnight. That's not news to us. But it's come a really, really long ways from September 2007 when we first sat down face to face with servicers and started talking about this. So I don't know if that's a scoop or a prediction, but.
I do think that, other than Patrick's wife seeing him more, which I think will be that's my prediction, I do think that the servicing standards are going to have a long impact in life. You know, I think time I think, you know, notwithstanding all the challenges and all the compliance issues that I think Joe faces every day, I do think that more people have seen the wisdom of the work that was done, and really the state AGs took the laboring oar with the bankruptcy trustees, as General Madigan said. So I do think that that document is going to long be an important one.
Hillary 2016. That's what you were looking for, right? I said my piece. No, I didn't.
So it's hard to follow that.
Academy Awards.
You're right. I guess I would obviously just echo what Patrick said. Somebody asked me if we were coming here to take a victory lap, and I said I've never heard of a victory lap while a race is still being run. And you know, we certainly recognize that this was a beginning of something new and an important one, but frankly, I work every day both on the implementation and on making sure that we're continuing to hold banks accountable for the activities that they engage in, and I know a lot of people in this room are doing that as well. And so my prediction is a lot more hard work to go, and certainly as the housing market improves and people take their focus off of these particular issues, there's still going to be homeowners who need help.
Okay. Well, we have 5 or 10 minutes for questions. We have a couple of our students who are circulating with microphones. I will call people in the queue that I recognize, see their hands. I would just ask you to speak into the microphone so we can record and pick up the audio, and to ask each of you to identify yourself by name and affiliation before your question or comment. We'll start over there.
My name is Tam Ormiston. I'm Chief Deputy of the Iowa Attorney General's Office. And this has just been a lot of fun to listen to, reminiscing about the impossible task that we actually had ahead of us. This could have failed, and in many respects did fail a number of times, and we breathed life back into it. You've talked about the relationships among government agencies, the feds, neighborhood agencies, the banking regulators. But there was another set of parties that I wonder if the panel could talk about this, and it's the relationship that we established with the people opposite us, the banks, the servicers. These are the biggest banks. They'd had their way for a good many years. They were lawyered up, and yet we got past a lot of the nonsense over a course of time. Could you just talk about where that went and the whole notion of trust in trying to establish a resolution and develop the mortgage standards that really made sense, not ones we tried to push, but ones that would work? Could you just talk about that dynamic?
I mean, I will say that although I do remember some nonsense, Tam, like, some nonsense sticks in my craw too. But I do think that there were a set of people who, at the servicers, who we ended up dealing with, particularly on the details of the servicing standards, who I think came at this in good faith, trying to solve problems, and were very realistic with us, I think, and very candid with us about, things like, look, we can negotiate for the next 3 months about you imposing that on us. We will never be able to comply. So can we figure out what is going to work for the consumer? And so that kind of, I think, candor was important, and particularly at that level in that set of discussions. I think there were, some real professionals who, understood they were working, in an area, as Patrick said, where the approach was broken, and they were, trying to find a way to improve it, recognizing that they were not going to be able to solve all the problems.
I would echo what Tom said, in particular about the servicing standards. That's the part I had the most involvement with, and they had a choice to make. How are they going to approach this? Are they going to come to the table? Are they going to fight everything? Or what are they going to do? And I think that there were certain people on their side who were smart enough to recognize that, one, this was a new day, that they were in a different legal environment because of what had happened with Dodd-Frank, but also that they really had a problem and that they needed to try to fix this. And so I echo Tom's comments.
Yes, sir.
My name is Gary Palm, and I'm an emeritus professor of law at the University of Chicago Law School, and I headed their legal aid clinic for 21 years. So I know about the problems of individuals, and you folks have done a marvelous job. But in terms of representing individuals in foreclosure defense, is it now sort of that a minimally adequate defense will have to require examination of these mandatory servicing standards in each case?
I'm not necessarily sure you have to look at them. What we've tried to do when we talk to the legal aid lawyers is to say, use these. And we've gone and we've trained the judges on the standards. Obviously, we've put in place, a lot of public information to ensure that people know what they are. But in a sense is, we wanted to give legal aid lawyers, housing counselors, tools to work with the homeowners. So, you don't submit paperwork and then not hear for who knows how many months, that they have to respond to you in a very short period of time. If they issue, a decision, you have the right to appeal. So we would like you to be able to argue. We'd like you to be trained so you know what those standards are, and then use those as a framework because we think that they're very good. In addition, as you heard, the CFPB is also putting those in place. So at this point, I think that should be the way folks operate. And if you want, we can come and do a training for your clinic. Debbie Hagan, can't wait.
My colleague Hank Rose.
One criticism I've heard of the efforts that the governments writ large have made in this area, and I don't necessarily agree with it, but I've heard it over and over on the talk shows and whatnot, is no one's ever gone to jail. None of the big players have ever faced criminal prosecution. What's your reaction to that? Is that a fair criticism or not?
I mean, happily, I get to answer this because I'm the civil guy. So, I had civil jurisdiction principally, except in environment, civil rights, and a couple of other areas. I think what, I'll say what, I'm sure you've heard from my colleagues at the Justice Department said that, these did prove to be exceptionally difficult cases to pursue. And one thing about the structure of the way I sort of think about this is, the Justice Department, you usually look at things criminally, and often when if that doesn't for whatever reason go anywhere, then you sort of look at things civilly. And I think you're seeing a recognition at the, whether it's through the RMBS task force, this, S&P, all of which are being brought in a civil context, that those tools may be the most effective ones, both to get some form of remedy and to get some form of remedy that actually helps people. Because a lot of the criminal penalties won't necessarily immediately help borrowers. But I absolutely understand the concern and the criticism made. I've heard it a lot. And I think that people shouldn't underestimate the value of all the other work that has been done. The people are very focused on why haven't the top people at the top banks been, put in jail. And, I think the one thing I've learned about having gotten into this so far is it is exceptionally complicated, the way all these structures were created, all this was done. And so I understand why the folks on the criminal side of the house found these not easy cases to make.
First, if we could bring the microphone down to Attorney General Dan, and then the woman behind him after that. Two rows in front. Oh, it is? Okay. Then you can pass it directly away. Thank you.
Hi, I'm Dory Rand, president of Woodstock Institute. As a consumer advocate, we've been going up against the federal regulators and their preemption standards for many years, and so it's wonderful that we got past that with this settlement. And I'm just curious to know, for those of you who were actually involved in the negotiations, who were the lead people there, say from the OCC and the Fed and the OTS? Because I know some of them aren't there anymore, thank goodness. We've got some new leadership at the OCC and in the chief counsel position. But I'm wondering who was there that you got to agree to let go of federal preemption?
Well, so all of the course of this, particularly with the banking regulators, the banking regulators weren't formally part of this settlement because they were pursuing their own reviews of robo-signing, and those things were always going to have three components. There was going to be a component that was going to be requiring the servicers to do certain things, on a going forward basis to improve their servicing. That's something that we chose to do in a much more detailed way, frankly, with the servicing standards. But a way in which the banking regulators, as we talked about and as Patrick talked about, it was a sea change that we were able to do that without sort of tussling with them, frankly. So that actually was I think a very good sort of collaborative relationship. On restitution, there too, we knew they were going to go in a particular direction with their independent file reviews. And we obviously chose to go a different direction, recognizing that there was going to be this other process. There was going to be more money coming. When and how was quite an unknown. I think, I had my own view about how long this was going to take, and I was pretty sure it was going to end up with somebody writing a big check because that's what was going to happen at the end. And then the last piece, really is the regulators' penalties. And that, I think, is an important piece of this, where I found the banking regulators to be tremendously collaborative. and because those, penalties might have been substantial, but they also would have just gone into the federal treasury. And so resolving this with, essentially resolving those penalties as part of this big resolution sort of lent us the opportunity to really use money to help consumers rather than just dumping it in the treasury.
And then, Dory, let me follow up in terms of preemption in general. In the midst of a lot of this, the Cuomo case came down. And so we then, as state AGs, finally were able to say, yes, there are areas in which we can enforce our laws. So we've got our consumer protection laws, our fair lending laws, we can bring those lawsuits. And really that's what freed us up to eventually sue Wells Fargo, a national bank, over the fair lending violations. And so that really changed things, in addition to Dodd-Frank putting in the preemption provisions that they did, again, recognizing that we do need to have, and we fought and fought and fought, directly to make sure that that happened. I mean, on calls with the White House saying, this is, a critical component, in large part looking at the history of what we'd already been through in terms of predatory lending, that we were really there on the front lines and don't take us out of being able to continue to do that. But those are two other, significant changes that occurred kind of in the midst of all of this regarding preemption.
Okay, we're going to take a question over there, and then Diana, if I could ask you to go in the back to pick up 2 questions afterwards, but we'll start over here.
Hi, I'm Steve Howe from the State Center. You talked about your truly incredible accomplishment of getting AGs from both sides of the aisle to work together, as well as General Madigan mentioned, sometimes hostile state and federal officials. I was wondering if you could talk about how you accomplished that, and is there some elixir we can distill from that to put in the water supply system in Washington, D.C. going forward?
Sure. Here's what it's a combination of. It's part Tom Perrelli, part Tom Miller, and part Sean Donovan, who literally were doing exactly what he just described earlier, which is they're on the phone every single, it's hard work. It's similar to being in a legislative body, right? Where you have to constantly reach out to people, hear what their concerns are, talk them through their concerns. But I would say that, those 3 people at that level, we're dealing with state AGs and, the heads of state and federal agencies to make that happen. But I would say it's hard work and commitment to making sure that this actually happens.
And also, commitment to actually listening to the different points of view and saying, okay, well, we're going to try and work through to address that. There is no question that that was a challenge, but it was a challenge that we got past sort of surprisingly fast, because there was real engagement and a real conversation. Like I would get on the phone with, frankly, sort of the Democratic AGs and the Republican AGs separately, and sort of talk through concerns and issues, and then work together to try and find a way to harmonize that. And it's not going to be easy to do in every case, but here, we really were able to do it. And it also, obviously, the backdrop is every single one of these folks, they want to help their constituents, and every single one of them had constituents who were telling them the same stories. It didn't matter whether you were an R or a D, you heard the same thing from people in your state.
I would add, though, that of course this was all happening with lawyers. So we talk about whether principal reduction was going to be a part of this or not. What Tom isn't talking about is the time he spent on the phone about whether the word reasonable would be inserted into a particular clause or not, only to then have to negotiate it with the other side after having worked it out on our side.
We have time for 2 more questions. I want to start with the gentleman in the back with his hand up. And then there was a woman.
I may have missed it, but I don't recall hearing anything about homeless veterans. And I'm trying to figure out, if you're going to have a settlement of this scope, what steps does the banking industry, the mortgage industry have in terms of taking all the abandoned housing that you have in a city like Chicago and make it available to veterans?
That's a good question. I don't know if folks are working on that at the local level. So there were two one was a military family, there's a set of provisions protecting military families that's currently serving. And there was a small piece of that didn't probably get a lot of discussion, where we resolved some fraud matters related to, alleged fraud matters related to veterans that actually brought a bunch of money in for VA. But the problem of homeless veterans is an enormous one that Secretary Donovan has been the lead for the federal government on. I think has done a terrific job, but it is a hard challenge.
Right. I think within the context of the settlement, I got a call after the settlement was entered from an organization that works with homeless veterans, asking exactly the question that you just asked. Is there an opportunity here for us to get vacant housing from the banks to be able to provide homes for veterans who are currently out on the streets? And it was very heartening to be able to connect them directly with the REO, the real estate owned portion of the banks, who they get credit under the settlement for donating that property dollar for dollar for exactly those types of purposes. It wasn't specific to veterans, but it was it definitely was heartening to be able to provide that connection to folks who previously had never heard of this opportunity being made available. And so whether that happened or not, I certainly would leave to those organizations to tout, but there is an opportunity for exactly the type of benefit that you described.
All right, I think we have time for one last question. I saw a hand. Yes.
Hello, my name is Barbara Heisha. I'm the director of CEDA's Housing Counseling Program. I just had a question in regards to the dollar point system that you described earlier that tracks servicers in meeting their obligations. Would that be posted and become transparent to the public?
The monitor?
Yes.
Right there. Joe Smith.
I'm
sorry, I didn't hear the question.
The crediting system is part of the settlement. It is public. We can get you a copy.
It's Exhibit D to the consent judgments that were filed. It's available online at nationalmortgagesettlement.com. Again, it's nationalmortgagesettlement.com, which is the website that the state AGs put up. You have all the consent judgments. There's another interesting website called mortgageoversight.com that is run by Joe, who, again, is sitting in the front row, mortgageoversight.com. And those two places are places where you can find a lot of good information, particularly along the lines of what you just asked.
Well, we are on the verge of lunch. I just want to, for those of you who are not familiar with Loyola, the lunch and the lunch keynote by Secretary Donovan will be in Casbier Hall, which is on the 15th floor. We have 2 elevator banks. Only the south elevator bank directly goes to 15. Otherwise, go to 14 and cross over. There will be students and other people who can lead that way. Please join me in thanking our whole panel for a great morning.